An absolutely brutal day on Wall Street. The stock market just went through one of its worst single-day declines this year. The Dow Jones plunged nearly 900 points. The Nasdaq dropped more than 820, and the S&P 500 fell by 182 points. It's the kind of red day that gets everyone talking and panicking. But if you understand what's really happening, this isn't a reason to be scared. It's the kind of opportunity that can make people rich over the next few years. Millionaires are made when the stock market crashes. And the bigger the decline, the bigger the opportunity. Especially when you can stay calm, think rationally, and be greedy when others are fearful. Before we dive in, this is not financial advice. If you find value in what I share, hit that like button and subscribe. It helps the channel grow and keeps you in the loop for major updates like this. So let's get straight to it. What caused this massive sell-off? How bad can it get? And why could this be one of the best chances to buy top quality stocks at a discount? Friday's crash was triggered by an announcement from former President Donald Trump, who said he plans to impose a 100% tariff on all goods imported from China, effective November 1st. That's just a few weeks away, and the market wasted no time reacting. This came right after China announced expanded export controls on rare earth materials, the critical metals used in AI chips, electric vehicles, smartphones, and defense systems. These materials power almost everything in modern technology, and China controls about 70% of the world's rare earth supply and over 90% of the processing. Now imagine what happens when a country that dominates that much of the supply chain decides to restrict exports. You guessed it. Global supply chains get squeezed, manufacturing costs rise, and investor confidence drops like a rock. That's exactly what we saw today. Tech stocks got hit especially hard. Nvidia, AMD, Apple, Tesla all saw steep declines. Semiconductor and AI-related software names were crushed, and even companies with strong fundamentals were dragged down with them. The tariffs themselves add another layer of pressure. Trump's proposed 100% tariff comes on top of existing ones, which could double or triple the cost of many products. And this time, the tone is different. He's signaling that he may not even attend high-level meetings with China next month, implying that these tariffs could stay in place for a while. Both sides appear more willing to endure economic pain to make their point, which is why markets are reacting so violently. So yes, this is serious. But here's the truth. It's likely a short-term shock, not a permanent collapse. Why? Because history tells us that trade war headlines always create chaos, but markets almost always bounce back stronger once the dust settles. Look at what happened in 2018. The first round of tariffs sent markets into a spiral, but within months, both countries were negotiating again and the market rallied. Even this April, when tariffs peaked at 145% during the so-called Liberation Day tensions, stocks rebounded quickly after a 90-day truce was announced. That's because while trade tensions make noise, both the US and China ultimately need each other economically. The US depends on China's manufacturing, and China depends on US consumers. No side can afford a full decoupling, no matter how harsh the rhetoric sounds. So while short-term pain is real, it's not the end of the world. It's the kind of reset that shakes out the emotional money and rewards patient investors. Now let's talk numbers. Historically, bull markets last an average of 4.3 years and return around 150% total. That's about 24% annually. Bear markets, on the other hand, last about 11 months on average, with a 32% drawdown. That means even though declines can be steep, bull markets last more than 3 times longer and return more than enough to erase every loss. In other words, these corrections are temporary setbacks in a much longer upward climb. Take the pandemic crash of 2020. The S&P 500 fell 34% in just over a month, one of the sharpest declines in history. But within 5 months, it had fully recovered and went on to hit record highs. Or look at 2018. That 20% drop looked devastating at the time, but it set up one of the strongest rallies in the following year. The pattern is clear. Short-term fear, long-term opportunity. The key is not to react emotionally. Data always beats feelings. So, how can we actually measure fear in the market? One of my favorite tools is CNN's Fear and Greed Index. It ranges from 0 to 100, and right now it's flashing fear. That's exactly what you want to see if you're waiting for a smart entry point. The index is made up of 7 indicators: market momentum, volatility, put-to-call ratios, demand for safe assets, and more. Out of all of them, I pay the most attention to 2: momentum and volatility. Momentum tells you whether stocks are trading above or below their average trend. I usually watch the 125-day moving average, about 6 months of trading. When market momentum dips below that, it's often a sign that stocks are oversold and close to a rebound. Back in April, when momentum dropped sharply, it perfectly aligned with the market bottom on April 8th. The second is the VIX, often called the Fear Index. It measures market volatility. Historically, when the VIX spikes above 30, that's a signal of peak panic, and a great time to start buying. Right now, the VIX hasn't reached that level yet, but it's climbing fast. If it breaks 30, that's my green light to start adding aggressively. So when should we be fearful, and when should we be greedy? The data gives us the answer. When the market's panicking and the VIX spikes, that's when opportunities are born. When momentum is low, fear is high, and valuations are compressed. That's when long-term investors quietly build wealth while everyone else is running scared. And let's be honest, it's not easy. Holding through a downturn requires patience and conviction. Most investors panic, sell at the bottom, and buy back near the top. But those who hold steady, or better yet, keep buying quality assets, end up multiplying their returns when the recovery comes. That's why keeping cash on the sidelines and dollar cost averaging is so powerful. Instead of trying to perfectly time the bottom, you consistently buy as prices fall. You reduce your average cost, increase your future upside, and eliminate emotion from the equation. Now let's talk about where I'm putting my focus. First, ETFs like QQQ and VGT. QQQ tracks the Nasdaq 100, the biggest, most innovative tech companies in the world. When tech falls, QQQ gives you exposure to giants like Apple, Microsoft, and Nvidia at discounted prices. VGT, Vanguard's Information Technology ETF, goes even broader. It includes software, hardware, and semiconductor firms with slightly lower volatility and lower fees. Both funds have proven track records and form the foundation of a strong, diversified long-term portfolio. Then come individual stocks, companies that are temporarily hurt by tariffs but remain long-term winners in the AI era. Let's start with CoreWeave, one of the fastest-growing AI-focused cloud infrastructure companies. They provide the GPU clusters, storage, and high-speed networking that power modern AI workloads. CoreWeave is also backed by Nvidia and gets priority access to its latest chips, giving it a moat that few competitors can match. Based on current valuation models, CoreWeave looks about 30 to 35% undervalued, which suggests significant upside once the panic selling fades. Another is Amazon, AMZN. The tariffs could weigh on its e-commerce segment short-term, but that's only half the story. The real growth driver for Amazon isn't retail, it's AWS, Amazon Web Services, and advertising. AWS dominates the global cloud computing market, and Amazon's ad business is now the third largest in the world, behind only Google and Meta. Amazon currently trades below its average price-to-earnings ratio from the past 2 years and is about 20% undervalued, according to DCF models. Once fear cools and cloud demand rebounds, Amazon's upside could easily exceed 25 to 30%. Speaking of Meta platforms, Meta, it's sitting on roughly 35% undervaluation by conservative models, implying more than 50% upside from current levels. Meta's focus on AI-driven content and advertising optimization continues to drive huge profitability. Even with all the market noise, the fundamentals remain incredibly strong. So, while short-term headlines create fear, long-term investors should be getting excited. These are the kinds of corrections where great companies go on sale, and history shows they rarely stay cheap for long. If you take anything away from this video, it's this: downturns create wealth for those who stay calm and act strategically. Fear sells news, but data creates results. Today's 900-point drop looks terrifying, but it's not the end. It's a beginning. Every past market correction has led to new all-time highs, and this one will too. It's just a matter of time. So when the market panics, don't follow the crowd. Follow the data. If this helped you see the opportunity in today's chaos, make sure to like this video and subscribe. I'll keep breaking down exactly what's moving the market, which stocks I'm watching, and how to position for the rebound that always follows the fear. Thanks for watching. And remember, millionaires aren't made in bull markets. They're made during crashes when everyone else is too scared to act.